Good afternoon. I am Jason Grumet, President of the Bipartisan Policy Center. It is a delight to welcome you to this afternoon's discussion with FDIC Chairman Jelena McWilliams. I think as most of you are probably aware, Chair McWilliams will be leaving the FDIC tomorrow after what can only be described as, I think, 3.5 years of intense public service. So really looking forward to the opportunity to talk both about some of the specific issues, but also some broader reflections about the challenges facing our financial system. Just to set the stage, I think it's fair to say that the FDIC is an agency that was literally formed in crisis, created to address the post-depression challenges that our banking system had faced. And by my account, Chairman, you have had a few crises of your own. Certainly we had the pandemic that we're still engaging, that I think has dramatically influenced the role of FDIC. There has been the growing awareness of the challenges of economic inclusion and the extent to which the pandemic has further set back a lot of disadvantaged communities. I know that's been a focus of yours. And then something that's really significant to us, which is the crises of partisanship and the extent to which the seepage of that kind of toxicity into all aspects of our public and private lives are making it harder for us to do the good work of governing a divided country. And so my hope is that we will have a chance to talk about all of that. But before I dive into questions, I think you'd like to offer some kind of framing remarks for the discussion. So welcome, and the floor is yours.
Thank you so much. Indeed, tomorrow, February 4th, will mark my last day as the 21st chairman of the Federal Deposit Insurance Corporation. And I would like to thank you, Jason, and the Bipartisan Policy Center for giving me an opportunity to share my closing remarks and engage when I have literally 24 hours left to go. As I reflect upon my tenure, I was actually taken aback by a stark fact. More than one half of my tenure, 100, exactly 100 of the 164 weeks that I served as FDIC chairman has been under the declaration of the national emergency due to the COVID-19 pandemic. Now, as you mentioned, the FDIC is no stranger to crises. It is an institution born of crisis that has successfully managed many crises since our founding in 1933. I knew that going into this job, we could, hypothetically speaking, have a crisis of some kind. What I could not possibly have anticipated was that the crisis we would have on our hands would be unlike any other the FDIC has endured in its history. And while no life experience can fully prepare a person for one of these jobs, let alone a job of running an agency tasked with maintaining financial stability in the middle of unprecedented instability caused by a global pandemic, some life experiences are indeed very useful. And I have to tell you, last summer, as I was commemorating my 30th anniversary of having immigrated to the United States, I could not help but reflect on the moment when I first landed at San Francisco Airport on my 18th birthday with $500 in my pocket. Now, my story is not different from that of many of the tired, poor, huddled masses yearning to breathe free, who see the United States as a land of opportunity. And like millions before me and millions after me, when you arrive in the United States with very little and struggle to survive, you quickly learn three things. Take nothing for granted. Our freedoms, opportunities, hopes, and dreams are unique and achievable. Learn as much as you can about everything. Knowledge is power, and once acquired, an obligation. And be flexible. The only constant is change, and change necessitates agility. That is how I approached my role at the FDIC in 2018, long before the onset of the pandemic. I wanted to learn, how did we get to the set of issues before us? What could a banking regulator do to foster a resilient and competitive financial system that enables people from all walks of life to achieve their American dream? So I will start with financial stability. The FDIC was established to maintain stability and public confidence in the nation's financial system. While March and April of 2020 may seem like a distant memory now, back then the crisis was shocking in its severity and speed. The economy entered into the deepest recession in the post-World War II era, contracting 31.2% in the second quarter on an annualized basis. We lost 22.4 million jobs in those 2 months. The S&P 500 index plummeted 33.6% by March 20th from its recent high. Liquidity in U.S. Treasury markets deteriorated rapidly, and many other markets came under significant stress. The story of how financial regulators, central banks, and the global financial system responded to the pandemic is one of great success. Only 3 banks failed since the start of the pandemic, and none due to the pandemic itself. At the FDIC, we took a broad array of actions to maintain stability in financial markets and provide flexibility to allow banks to work with their customers and support the economic recovery. We worked hand in hand with our regulatory counterparts in a coordinated fashion and with remarkable speed to prevent the shock of the pandemic from irreparably damaging our economy and banking system. Technology was an incredible asset. The FDIC and the institutions we regulate were able to transition to a remote working environment literally overnight, yet financial markets continued to function and FDIC exams proceeded as scheduled. We closed a failed bank in the early weeks of the pandemic using an entirely new playbook, and we sent only 10 employees on site rather than the usual 70. Even throughout the pandemic, we have continued to prioritize improving supervision and resolution planning for large banks. In 2019, I announced the creation of a new division, the Division of Complex Institution Supervision and Resolution, to centralize for the first time our supervision and resolution activities for the largest banks. Combining resolution and supervision allows information, resources, and expertise to be shared in advance and to be readily available in the event of a crisis. We have also continued to improve resolution readiness. The U.S. Global Systemically Important Banking Organizations, or the GSIBs, have implemented significant structural and operational improvements that have enhanced their resolvability in bankruptcy. We have remained focused on ensuring that firms continue to enhance, test, and operationalize their capabilities and systems to implement an orderly resolution if needed. We have also further built out our own resolution capabilities at the FDIC, including by conducting a series of operational exercises to practice carrying out key resolution functions. The FDIC has also modified its approach to resolution planning for regional banks. The modified approach places greater focus on direct engagement with firms and capabilities testing, while streamlining content requirements for resolution plans. We implemented a record-keeping rule which requires large banks to configure their IT systems to calculate the insured and uninsured amount in each deposit account to help ensure that the FDIC can deliver timely payments to depositors if a large bank were to fail. In April of 2021, the 25 largest banks came into compliance with this rule, and while more work remains to be done, they have been able to demonstrate the ability to deliver an insurance determination for the vast majority of their deposit accounts. The FDIC recently simplified the deposit insurance rules for trust accounts to facilitate a quicker and less burdensome resolution if a bank with a large number of trust accounts were to fail. In 2008, when IndyMac Bank failed, FDIC claims personnel needed to contact more than 10,500 depositors to obtain the necessary trust documentation. This process took several months to complete, during which a large number of insured depositors could not access insured funds. We also devoted substantial time to addressing the significant challenges the FDIC might face if a bank holding deposit accounts from numerous large prepaid card programs were to fail. Although FDIC board members were unable to reach agreement on a path forward, given the increased popularity of prepaid card products, particularly among lower income households, this is an issue that continues to warrant attention by the FDIC. Important preparations also continue to enhance the FDIC's readiness if it is ever called upon to resolve non-bank firms, such as central counterparties or CCPs. CCPs play a critical role in the financial system. Their clearing services are central to U.S. financial markets. And accordingly, we have been keenly focused on resolution outcomes that avoid or mitigate serious adverse effects on U.S. financial stability and ensure that CCP's critical services remain available. The FDIC has continued to engage with domestic and international counterparts to further develop policies and resolution strategies for CCP resolution. This work remains a priority at the Financial Stability Board's Resolution Steering Group, where I recently served as chair. We have continued to prioritize the importance of strong capital levels, particularly at our nation's largest banks. The lead depository institutions of the 8 United States GSIBs grew their capital levels over the last several years despite stressful economic conditions, owing to rigorous capital requirements that were in place entering this period. The weighted average CET1 capital ratio of these institutions increased from 12.9% in the third quarter of 2018 to 14.5% as of the third quarter of 2021. Capital adequacy remains robust across the broader industry as well, including in the community banking sector. This strong capital position allowed the banking industry to serve as a source of strength to help individuals and small businesses navigate through the economic stress generated by the pandemic. Looking forward, as the banking agencies consider modifications to the regulatory capital rules pursuant to the so-called Basel III Endgame, careful consideration should be given to the strong capital levels currently in place across the banking system, including at the largest banks. I'm hopeful that revisions to the capital framework will reduce complexity and rationalize the many calculations necessary to determine capital adequacy. Similarly, these modifications should be thoughtfully incorporated to minimize advantages or disadvantages to banks of different sizes or different business models, and the agencies should be mindful of any additional burdens imposed on small banks. The banking system is healthy, and this reality should be a key consideration as the agencies weigh revisions to the capital framework. I will now turn to competition, innovation, and inclusion, the guiding principles of my chairmanship that helped forge the most vibrant financial market in the world. From day one of my tenure, we set out on an aggressive agenda to ensure the FDIC's policies, supervisory approach, and engagement strategy supported these goals. Enhancing competition in the financial services marketplace is more than just looking at the number of banks in the United States. It requires looking deeply at the pressure on banks to scale, the costs of IT modernization, regulatory compliance costs, the rise of non-bank competitors, and the changing expectations of customers. We embarked on a number of initiatives to address these deeper issues. To encourage de novo activity, we took several actions, including revising our process for reviewing deposit insurance proposals to provide initial feedback to organizers on draft applications prior to submission. During my tenure, the FDIC has approved deposit insurance applications for 49 de novo banks, compared to just 10 approvals between January 1st of 2011 and June 5th of 2018. Innovation is the critical ingredient that fosters both a competitive banking sector and one that supports financial inclusion by democratizing finance. More competition spurs new products and services and cuts costs for those products, increasing consumer access to the financial system. We created FDI Tech, an innovation lab and a collaborative forum for regulators and the private sector to better understand new technologies, identify regulatory impediments to innovation, and create solutions to specific challenges through tech sprints. Our first rapid-phased prototyping competition focused on providing regulators with more timely and granular access to bank data, and these creative solutions will soon be tested in a pilot program. Innovation requires a significant investment of resources, from procurement and deployment of technologies to hiring and training a skilled workforce. Independently developing and deploying new technologies can be difficult for community banks because of economies of scale. That is why partnering with a fintech that has already developed, tested, and rolled out new technology can be critical for a small bank. Yet the onboarding and due diligence process can be costly and time-consuming. In July of 2020, we proposed a public-private organization to establish standards for due diligence of vendors and their technologies. The FDIC would participate with industry and other stakeholders to develop these standards. Fintechs could then voluntarily submit their technologies to this certifying organization to verify conformance to the applicable standards. In turn, banks could rely on this certification to efficiently onboard the vendor. Although my time at the FDIC is ending in 24 hours I continue to encourage the agency and our regulatory partners to pursue this initiative. Another key aspect of our pro-competition agenda has been modernizing a broad range of our rules while maintaining our core safety and soundness focus. Implementation of Senate Bill S-2155, modernizing our broker deposit rules, simplifying the VOCA rule, and tailoring application of enhanced prudential standards were among the FDIC's many achievements in recalibrating our rules to strike the proper balance between safety and soundness and promoting economic growth and innovation. We also took other steps to promote good governance. For example, we established a new Office of Supervisory Appeals to hear appeals by banks of supervisory determinations made by examiners. Over the past few months, the banking agencies have focused intently on crypto assets. While activity in crypto markets has exploded in recent years, banks' engagement in such activity remains limited despite substantial demand. A key reason for this lack of engagement by banks is legal and regulatory uncertainty and the need for supervisory clarity. In November, the banking agencies issued a joint statement laying out a roadmap for work the agencies plan to complete in 2022. I urge the agencies to continue pushing forward with this work and to focus on articulating policies that give banks and the public a clear understanding of supervisory expectations. One work stream has focused on bank-issued stablecoins, which could provide for faster, cheaper, and more efficient ways to move money from place to place. A key question that the FDIC has been carefully exploring is whether a stablecoin or the funds represented by a stablecoin meets the definition of deposit under the Federal Deposit Insurance Act, and relatedly, whether stablecoins could be eligible for deposit insurance. These are critical questions with major ramifications for the evolution of stablecoins. My personal view is that generally, bank-issued stablecoins closely resemble digital representation of deposits. I urge the FDIC to build off the work we have done and provide clarity to the public as soon as practicable, which could include promulgating amendments to the deposit insurance rules. With respect to the broader interagency stablecoin work, I encourage the agencies to be mindful of the many possible iterations of stablecoins we may see and to avoid a one-size-fits-all approach. For example, the regulatory framework for a GSIB issuing stablecoins may need to be very different from that of a $1 billion bank. Likewise, a bank experimenting with stablecoins is a small percentage of its business likely warrants a different regulatory approach from a bank whose sole business is stablecoin issuance. I have placed great emphasis during my tenure on inclusion, both in our financial system and at the FDIC. 2 weeks ago, in collaboration with the National Bankers Association, I delivered a speech on why regulators must think outside the box in order to advance diversity and inclusion across financial services and inside the agencies. In the interest of time, I will not repeat those remarks here, but will mention two things I'm especially proud of. The creation of the mission-driven bank fund to drive capital investments and other funding to support low and moderate income, minority, and rural communities, and the cultural shift at the FDIC to make sure that our workforce feels heard, valued, and appreciated. I encourage those interested in more details on how we were able to achieve that, what many actually have considered and described as impossible, to actually look at that speech. 3.5 years ago, I assumed the chairmanship of the FDIC, determined to support the American dynamism that allows someone like me to reach my highest potential in this country. Not a day passed by when I did not think about how rare, perhaps unthinkable, it would be in many countries for a foreign-born girl with a hard-to-pronounce name, no money, and no connections to someday become chairman of an important federal government agency. But 30 years ago, this foreign-born girl made a journey to the best, likely the only country in the world where that would be possible. Guided by a firm belief that the role of government in our society is to promote, not inhibit, growth and innovation, I challenged myself and the FDIC staff to think outside the box, to support a thriving, competitive, and innovating banking system that will continue to propel this nation forward. In closing, As our American values, culture, and influence face increasing competition from abroad, the FDIC has demonstrated that with ingenuity and agility, we can support an innovative banking system that allows our banks to continue to be the nurseries of national wealth while enabling more people to benefit from it. None of these achievements would have been possible without the committed staff of the FDIC, who have my profound gratitude. I'm humbled by their dedication to the FDIC's mission and honored to have served with them. Thank you, and I'm happy to take your questions now.
Well, thank you, Madam Chairman. I struggle with the Madam Chairman thing, but I know it's the right thing to do. I'm just gonna roll with it.
Yeah, you can just say Jelena. It's okay. Tomorrow, I'm no longer chairman. How's that? Tomorrow,
I will go with Jelena. For today, right. Madam Chairman, really important, I think, to look back at some of the specifics, because at this moment, so much of the political national conversation just assumes that government is incapable of doing anything. But I really want to focus on kind of where you ended, which is thinking forward about the challenges for FDIC and other key financial institutions. So I want to talk a little more about the pandemic, and then probably a little more about fintech and our wonderful democracy. So after 2008, the kind of after action report was the government wasn't that coordinated, right? Every agency had a slightly different mandate and a slightly different anxiety. And so we created the Financial Stability Oversight Council, right? FSOC, which for some was kind of a euphemism for good luck with that, right? The idea that we were going to get all the agencies to work together. But it kind of seems from the cheap seats that that actually worked pretty well. And I wonder if you can kind of give us a sense of, where was that really helpful, but also where is there still work to do on that idea of kind of coordination in crisis?
No, it's a phenomenal question. And I'll tell you why. I remember back in 2008, I was at the Federal Reserve. And trust me, we tried to coordinate, but it was very difficult to coordinate at the time, despite all of the interagency working groups and president's working group, et cetera, et cetera. So when the FSOC was created, it was meant actually to be this amalgamation of all the regulators. They meet once a month. So there's this standing meeting, and it's chaired by the Secretary of the Treasury. And so I have to tell you that for years, you mentioned cheap seats. I had a cheap seat for years. And then I got an expensive one in 2018 when I assumed this role. And I went with anticipation to see what the first FSOC meeting would look like. And so I will tell you this, there's no wizard behind the curtain. It's just us regulators. We have an agenda. We meet every month. And frankly, there's a lot of collaboration that takes place in those meetings. People are able to express their opinions. Usually we have a staff from the agency that's charged with whatever is the agenda item. If it's within that agency's mandate, the staff will present how they are looking, if it's the Federal Reserve or the FDIC, for example, or OCC, how they're looking at a particular issue, whether be it leveraged lending or concentrations of, commercial real estate and a number of other things. And then we'll kind of go around the table and debate things. Everybody expresses their opinion, and usually it's an engaging discussion. And I will tell you that at least in those meetings, for all of the dysfunction that people describe, the government is functioning well. People are very generally cognizant that we all have an important job to do. And by virtue of how the terms of the agency heads have been set up, the Federal Reserve has, the governors have a 14-year term. The chairman, I believe, is four-year term. At the FDIC, the chairman has a 5-year term, and at some other agencies, it's a different number of years. But these terms are set up in a way that inevitably they will spill from one administration to another, and so we have to work together well for the sake of the American people. And I think that quite often I have said, American prosperity is neither blue nor red. And we need to bring that attitude to the table when we have to negotiate what matters for the economy. And frankly, that's exactly what we did during the CARES Act. And before the CARES Act, negotiating just on different individual relief to give to the banks.
And another argument for maybe not having TV cameras in every governing conversation. Okay, let's talk a little bit about the private sector. I remember you saying at one point that also when you were at the Fed, you felt kind of hamstrung, right? People were calling up in these desperate situations, and the rules just did not allow the nimbleness to be effective and compassionate. How did the banks respond at the beginning of the pandemic? I mean, were they Were they creative, constructive players, or were they kind of hamstrung themselves by kind of a regulatory system that wasn't anticipating this kind of crisis?
So I will tell you this, a lot has been learned, I think, by both the regulatory agencies and by banks from the 2008 financial crisis. And from my perspective, having been at the Federal Reserve as a consumer protection attorney back in 2008 and getting those calls from the consumers who actually didn't even know how to modify their loans or where to send the documents and who the difference between a servicer and the holder of the mortgage note. I basically was in shock in March of 2020. I said, there's no way we can have a repeat of that. No matter what needs to be done is we're going to do to make sure people can stay in their homes and we don't have this wave of foreclosures that just drives the economy down and people lose their homes, et cetera. And so early on, I started making calls to our largest banks, supervised by the FDIC, and asking them specifically, are you working with your customers? We need people not to lose their homes. We need people to have access to credit. And yes, some people lost jobs from the government-related closures due to the COVID pandemic in many states, but we need you to work with them. And every single CEO, literally every single CEO that I talked to, and there were probably about a dozen of them in early March, basically told me, I'm ahead of you. We're talking to customers. In many cases, they said, I'm personally calling our customers as well and seeing how can we help. And they said, but we have one terrible thing that we don't know how to deal with. And that is that if we modify mortgages, we modify loans, for the reasons that are related to the pandemic, they're nonetheless under the GAAP accounting principles going to be considered troubled debt restructuring, the so-called TDRs or impaired debt. And that's what happened, by the way, back in 2008. A lot of banks were hesitant to modify loans because they would have high concentration of TDRs on their books. And a high concentration of TDRs on their books looks bad to the examiners and looks bad to the outside investors. And so I remember telling our staff, call over to FASB, Financial Services Accounting Board. Financial Accounting Standards Board, I apologize. Call over to FASB and make sure that they work with us on ensuring that these modifications for loans that were performing before the pandemic actually are not TDRs. And that call, that phone call allowed banks across the United States, numerous banks, to modify loans aggressively. And quite often people like to talk about negative things, sensational things. Oh, things were so bad, etc. And the reason that you actually don't hear a lot about regulatory failures during the pandemic is because we worked exceptionally quickly, exceptionally collaboratively, and there was no turf battle among the agencies. Basically, everybody huddled together and said, "What do you need? Let's go."
So let's talk about the little guys that are the engines of the economy. I think during the pandemic, between PPP and the economic disaster loans, governments moved about $1 trillion into small business lending. Where do you see small business lending going forwards? And I think some component of that is obviously kind of the question around stability, but there's also, I think, a fintech issue that I think we will start to draw into the discussion.
Yeah, no, it's a great question. And having spent a little bit of time on the United States Senate Small Business and Entrepreneurship Committee, I looked kind of at the small business formation and funding and capital access quite carefully. I would say that despite concerns about small businesses during the pandemic, in 2021, new business applications were up, bankruptcy filings were down, and capital investments and inventories grew. So that's all positive. This would all suggest that small business lending, which is especially important to community banks, will continue to grow. And we monitor these developments through our call report data, and we report it on a quarterly basis to what we call quarterly banking report, or QBPs. Now, community banks are actually a key player in the small business lending space. They're a key resource to small businesses needing credit. This is kind of like their niche area, and they're in many cases more successful lending to small businesses than larger banks. We did a community banking study in December of 2020. And that study, it was completed in December of 2020, it took a while. But that study showed that community banks hold about 36% of total small business loans, which is double their share of the banking industry's total loans, which is around 15%. And then also it showed that community banks tend to focus on larger loans to small businesses that require greater touch or interaction and analysis. Quite often these loans are very intense. Why? Because small businesses have quite often not common revenue streams. The record keeping is not as good as or as efficient, I would say, sometimes as you would get from more established businesses. And so that personal touch the community banks bring to the table is what allows them to be really good in this space and to actually expand the relationships between banks and borrowers. So I think as we look at small business lending today, I think they're in a very good place. And, of course, you can never have enough credit or capital to have a vibrant economy, and more is better so long as it's safe and sound and underwritten well. But I will say that for all of the concern that we had at the onset of the pandemic, with so many small businesses not being able to survive and shutting their doors down, we're actually on a very good trajectory with small businesses and small business lending at this point in time.
So the kind of last pandemic question I want to talk about is just the fact that, banks talk about innovation a lot, but they're not really probably the most innovative, entities in our economy. They're pretty careful for some good reason. The pandemic obviously forced a lot of changes, not only this kind of two-dimensional discussion we're having right now, but I'm sure across the way FDIC operates, across the financial sector. The Bipartisan Policy Center is going to hopefully be coming back to work this month, and we are trying to think through, how do you optimize what we've learned with the actual ability now to see each other in person. And so just talk a little bit broadly about what do you think are the benefits of the crisis-driven innovation that we're going to hang on to?
So I will say that for the pandemic being as tragic as it has been, and the loss of life and economic opportunities for people as tragic as they have been, I will say that there is silver lining in all of that. And the silver lining for us has been that both banks have innovated and adjusted to this new environment. And we, as a supervisory agency, had to do the same. So all of a sudden, we went off-site exams. Like we still have to do exams, right? We can't go into the facility. We don't know how contagious this virus is. Remember back at the time, I remember going to Costco to do grocery shopping, and I literally looked like a ninja. I think I had like a scarf and a baseball hat and glasses and not touching anything. And so when you have that environment, you still have to fulfill the mandate of the agency, which is to examine banks. And as the supervisor of the largest number of very small banks that are not very technologically advanced in many cases, a lot of their files are paper files. So we had to adjust to continue to do our work by modernizing our supervisory process and examination. I know in some cases we even offered to send high-speed scanners to some of these banks so they can upload multiple hundreds of pages of documents in several minutes. And in many other cases, we had to adjust our technology, and so did banks, right? Banks, in many cases, I remember talking to the CEOs and saying, "Are people coming to the ATMs? Are people coming to your windows? And most of the banks kept some staff inside, but then they had to move their operations remotely. And I think that a lot of the good things that came out of that innovation, ingenuity, agility, the ability to kind of switch things on a moment's notice is going to stay. I know for us at the FDIC, we're going to go into more of a hybrid approach to examinations going forward. Why? Because we now know it can be done and it can produce good quality results. So our examiners will spend fewer number of days on site at the bank and more days off site, meaning at our facilities, at our offices, analyzing the documents. So that reduces some of the burden from the bank. It still provides the bank, one-on-one personal touch with their examiner, but we won't be there for 3 weeks. Maybe we'll be there for 10 days or 7 days. And I think that's just going to increase efficiencies in the system.
All right. Well, one more, I think, what I would describe as a fintech question. You raised crypto. So I think there are hundreds of thousands, if not more, people watching this on networks as well as our own live stream. So on behalf of almost all of them, I guess my question is, what's crypto? And to unpack that a little bit, what does it mean for the financial systems of the United States of America? Because I think a lot of discussion has been dark web and all these nefarious, but this is not, in fact, just a hobby anymore. So are we ready for it? Are banks ready for it? How do they get ready for it?
So I will tell you this, as we look at the developments on the blockchain, distributed ledger, and in the crypto space, both with respect to like crypto assets and just generally what the blockchain technologies can provide, the efficiencies in the system and and the ability of using machine learning, artificial intelligence. I think on the regulatory side, at least from my perspective, we need to be more open to this innovation. You mentioned dark web. There has been, some activity in the past that, and still activity that takes to this day that takes place on the dark web. But let's not throw the baby out with the bathwater, right? There's so much opportunity here to have better payment system, to procure better loan products, to utilize technology to actually improve compliance systems. And so I truly feel this is a revolutionary time we're in. This is as big as the invention of internet. As we look at how our financial service is going to be offered, what will the banking of the future look like? How are we going to be exchanging payments? What is going to be money of the future? And I think there's an opportunity here for us to be careful, but at the same time, not be so careful that we stifle innovation. And I often think about, why did I come to the United States? I didn't come to the United States. I could have gone to other countries back in 1991 when I made a decision. I made a decision in 1990, but I could have gone to many other. I could have gone to Germany, the UK. I could have gone to France. I could have gone to Australia, Canada. No, I only wanted to come to the United States. Why? Because the American ingenuity, the entrepreneurship that can grow here, the possibility to create the impossible and create products and services that improve people's lives and change history and how we do things. Pretty much, this is the incubator. The United States is the incubator for that. It happens in some other countries, but nowhere on a scale as massive as the United States. And so from a regulatory perspective, I will say it's both a matter of national competitiveness to allow these technologies to exist. Again, we need to be responsible about how we regulate them. They need to be managed responsibly by the side of the providers of those technologies. But I think also there is a question of national security. If we don't implement some of these technologies and allow them to foster to make our financial system better, other countries will. And frankly, some of the regulations we have, especially with Bank Secrecy Act, anti-money laundering efforts, the ability of banks to know their customers, these technologies can only improve those processes. So I will say overall, I hope that regulators are going to be more open going forward about the possibilities, the endless possibilities that rest here, and not literally foreclose the future for so many Americans.
So I bet just about everybody watching and listening will agree with you that one of our superpowers in the United States of America is that creativity and entrepreneurship and sense of possibility. And it's all founded, I believe, on the capacity to have a free and fair and diverse society that resolves conflicts through conversation, nonviolence, effective governance. And that's kind of come home in a way that has been pretty troubling for a lot of us in the last few years. So let's talk about how the political system is challenging our regulatory structures, right? Just to kind of increase my preamble here a little bit. It's not just FDIC, right? Social Security Administration, CFPB, the post office, not to mention the Department of Justice and DOD and state election offices. I mean, a whole lot of places that we all kind of thought they weren't sacrosanct, but there was a certain norm of where the lines should be drawn between political interests and technical expertise. Those seem to be pretty brittle. And so, I don't know how much you want to talk about, your own experiences at FDIC, but just broadly, what are we going to do? I mean, I think this is a big problem. Do you think this is a big problem?
So this is what I think. And again, you're asking a person who comes from a kind of a banana republic style of government that was before the banana republic had communism. So my system of reference is shaped by, I know how bad things can get. And so when I first came to the United States, I was astonished at the principle and the rule of law. And really, when you think about why businesses foster and grow and prosper in the United States, it is because of the rule of law. We have this long established system of governance, and businesses are able to develop and grow knowing that these long established principles of governance and government will be in place. And so when you have a breakdown in the kind of the independent agencies norms that frankly don't bode well, not just for the agencies themselves, but for the American people. Nobody wants to see their regulators be in a position where there is political paralysis and nothing good comes out of these agencies. And in the end, don't take these jobs if you're not going to be working for the American people and for the American prosperity. And again, these jobs are, highly politically charged. You have to understand what you're dealing with. And in the end, I frankly believe in the institution that is the FDIC. I believe in our independent government agencies. I believe in the independence of the federal regulatory agencies. There is a reason Congress set us up the way it did. And the chairman's terms being expanding beyond and above the president's terms in many cases, as well as having bipartisan boards and how the process is supposed to be unfolding for different procedural and policy structures. And so I will say that I will forever respect that. And, one of the, if you have a Wall Street Journal subscription, you know what has happened at the FDIC board, but I will forever put the needs of the country and the independence of the agencies and the comity that is so necessary before any personal self-interest and anything else. So therefore, tomorrow will be my last day, and I hope that people continue to work well together long past my departure.
Well, you are excused from having to solve this, and I will not take too much hubristic responsibility, but we think this is going to be a problem that's not going away. And I think legislation was introduced yesterday to stop political meddling at the FDIC. There's certainly going to be tremendous amounts of continued efforts. Congress is thinking about how you stop political parties from meddling and counting votes. I mean, this is a different kind of environment. I was had a little PTSD remembering Humphreys versus Executor, 1935, the last time this. So, buckle up, folks, because I think the question of agency and expert independence is just getting engaged. So I got a couple more questions after that little commercial announcement. One of the places where it seems like the partisanship is the hardest to address is on prospective agenda setting, because there's not a history of an understanding of how the kind of rules of those exercises move forwards. And so I'm thinking about climate change and the FSOC's efforts and trying to understand what is the role of financial regulators and climate risk. And as we talk, I expect that Ms. Raskin is having the same conversation with a lot of people. Where do you stand on just the responsibilities, opportunities of the banking system in thinking about climate risk?
It's a great question, obviously a question that's very in vogue and relevant as we speak. And I will tell you what I have said all along. I didn't approach this issue lightly. When I came to the FDIC, I asked, how are we looking at climate change, weather-related events, both in the bank's underwriting models? How are we looking in terms of how our banks are managing the risks related to weather-related events? And what can the FDIC do? What is there anything else for us to do? And so I will tell you this: what I have been really pleasantly surprised by is that I wish I could claim credit for this, but I can't, because it existed for decades before I arrived. The FDIC supervisors have long expected financial institutions to consider and appropriately address potential climate risks that could arise in their operating environments as a meaningful safety and soundness concern. So what does that mean? That means that if you are underwriting mortgages in a flood zone, you better know how to, where the flood patterns are and the flood zone ends, and how to appropriately protect the collateral. Same for the peril of wind. If you're underwriting loans in California where there's risk of wildfires, you need to take that into account. Now, the negative aspect of that is that the insurance in those areas is getting more expensive, but from the bank's perspective, they have to protect the collateral. And so we at the FDIC also did, our economists and researchers did a study to see, did banks fail? How did banks fare after some of the major climate events, weather events over the last couple of decades? And what it turned out to be is that no bank has failed as a result of these events. Moreover, most of the banks actually saw infusion of deposits, either from FEMA, other government relief, or private insurance money in the aftermath of catastrophic weather-related events. So it's a balancing act, and here's why. What is the role of a regulatory agency in how we address the climate change, right? That's the issue that's really being debated today politically and substantively and in many different rooms around this town and I'm sure elsewhere in the United States. And I will tell you that from the FDIC's perspective, we do expect institutions to mitigate the risks associated with adverse climate or weather-related events based on the locations where they function. We do have regional committees that include that meet and they analyze climate related developments in that specific region. They look at environmental factors in their regular analysis and then change the standards accordingly if they think the standards have not been appropriate. And so I will say that what I don't appreciate in the debate about the financial regulatory system and the climate change is that quite often it seems like the regulators are, asleep at the switch. Nothing has been done. When in fact, our examiners on the ground have been keenly aware of these developments and monitoring them with the individual institutions we supervise on an ad hoc basis for, at least 2-3 decades now, if not longer. So I will say that can more be done, is up for the future regulators to decide. And I think from my perspective, at least, I'm comfortable knowing that where the FDIC has been for a long time with respect to this, and knowing that the data that we have analyzed to see if weather-related events, severe weather-related events, have a negative impact on banks themselves, and we didn't find evidence of that.
Well, Madam Chairman, I think we are at time, though I know we could talk for many, many more hours about a lot of these issues. I think we think there's no higher purpose than public service, and really appreciate all the hard work you have done for this country. And I'm sure that we will be hearing from you and seeing you again very soon. So have a great last day.
Thank you so much, Jason. I can cherish the title of the chairman for another day, and I look forward to seeing you on the other side. Thank you for the opportunity, and I will also take advantage. Can I just do 20 seconds plug in for public service?
Sure.
There truly is no greater reward in life than being able to serve your country, and I am both humbled by the opportunity that has been given to me in different venues at the Federal Reserve, in the Senate, on a couple of Senate committees, and now at the FDIC. And I will tell you that as somebody who had to earn the honor of being called American, I would do it again in a heartbeat. So with that, I want to thank you and BPC for hosting us today and wish you best of luck.
You too. Thank you, everybody.